Hi guys, I am Rashad, presenter of your weekly program Hit the Road to F.I.R.E, in which we talk about the stories of companies and investing in the stock market. In the world of long-term investment, everyone agrees that time is the cornerstone, but there is a difference in the method of investment. Is active investing better or passive investing? What is the difference between them and what is best for you? We'll see the answer in this episode. The active investor monitors companies, analyzes and understands them, until he finds the opportunities that lie in them, because his goal is to choose specific companies that bring him returns for his investment that are better than the returns of the market as a whole, which range between 6 and 15%. Within the name of active investing, there are many multiple strategies that sometimes contradict each other. One of the examples we have is the long-term investor and the trader, both of which are very different from the other, although each is an active investor. But our focus in the channel is the long-term investment. And unlike the active investor, you find the passive investor. This type of investment depends on the principle that you have surely heard about, and it is the diversification that many experts and portfolio managers advise. This type do not incurs the trouble of researching and analyzing each company separately, but rather invests surplus money in the market as a whole. Or sometimes in specific sectors or companies with specific sizes, but he invests in general and not in particular. The static investor is convinced of the efficiency of integrated markets according to efficient market hypotheses. And if this theory is correct, this means that it is impossible for any investor to consistently outperform the market. How is that? The efficient market hypothesis revolves around the idea of distributing information efficiently in free markets. What is meant by the above is that there is neither an expensive share nor a cheap one, but because of the equal and clear distribution of information, the share price, that is the market value, always reflects the intrinsic value or the real value of the company. Therefore, the investment is clear and many people actually follow this hypothesis and achieve satisfying results. Beautiful, true? No, wrong, dear viewer. I mean, it is true that the hypothesis is generally correct, but there are vivid examples that refute and destroy the hypothesis, and they prove that it is possible to achieve returns that are much better than the returns of the market constantly, and the biggest example is Warren Buffett. How is that? First, give us a like for Warren Buffett so I can tell you. The first thing, let's think logically. You yourself will certainly see fluctuations in the shares of companies, if that is an unreasonable rise or fall within a short period of weeks or days, or even hours, and the closest example is the fluctuations in shares of technology companies and others that happened and is happening during this crisis. I mean, it is reasonable for the companies that have actually decreased by 10 or 20%, their value suddenly decreased like this within 1 week, for sure not. And an even crazier example, GameStop, and its value increased by 1,700% within a few days, so it is clear that often the market value does not reflect the intrinsic value. But investing in the stock market at that time is irrational. Yes, dear viewer, no rationality exists in the stock market. I mean, you find people buying the stock or selling it just because a group wrote on Reddit forums or because a celebrity tweeted, like Elon Musk's tweet about an app signal, which many misunderstood and went to buy a share signal, and then the share price fell overnight. This shows that in these moments there is a mismatch between the market value and the intrinsic value, and here lies a profitable investment opportunity that is exploited by the active investor such as Buffett and his ilk. You may not be interested in all of the above, but the question remains, which type of investment is best for you? Dear viewer, the answer lies in time and risk. If you want to be an active investor like Warren Buffett, you must have enough time to learn active investing and to follow the news of companies and analyze them individually from the fundamentals, financial bonds, and others, as we will explain this in the upcoming files until you decide which investments are the best. In addition to having the patience to take risks so that you do not sell as soon as the stock goes down, which is one of the secrets of the failure of investors. If you have these qualities, you can actually think about considering active investing and tell you that the issue is not as difficult or complicated as you imagine. Warren Buffett himself says that it does not require high IQ level. But if you don't have time and you want an easier solution, the easiest solution and the return of which is almost in line with the return of the market as a whole and is not very high like Warren Buffett and others, is that you firmly invest stocks, index funds or ETF. Investing in the long term means investing by making monthly contribution, or every quarter you take a little money and put it in ETF. And of course there are types even for this passive investment, is that you focus on packages of companies with specific technologies in specific areas or even in specific countries, or that you focus your investment at specific times. For example, instead of investing every month or quarter, You invest when the market crashes or when a correction occurs, as happened with Nasdaq. Dear viewer, you may ask yourself why I don't give my money to someone so that they invest it for me, for example, portfolio managers. Let me not answer you myself, but the numbers will. There are studies over a period of about 30 years that show that portfolio managers who choose stocks one by one achieved profits of about 3.6% annually, while the markets achieved 9% annually. Do you see the difference? And this is in addition to the operational costs that can be paid to portfolio managers regardless. Consider whether you win or lose, and also the fraud stories that you may have heard about before. In general, Charlie Munger and Warren Buffett say that there is no need to put your money in the hands of portfolio managers. In the darkest cases, be a passive investor. Invest yourself through stock packages. As we mentioned before, do not depend on anyone. The matter is simple. Of course, to clarify, this is not a financial advice that you apply immediately, but I wanted to warn about the risks of some portfolio managers. But on the other hand, it is known that there are many good portfolio managers who achieve high profit rates for their investors. Dear viewer, whatever path you have chosen, whether it is active or passive investment or a mixture of them, you have taken a correct step towards financial freedom. But this is only the first step, and there is still a very important second step, which is that you subscribe to the channel and activate the bell button so that you know when we are uploading episodes in the future for you to benefit, and there is no need to wait. Watch our previous episodes to learn more about investment. And do not forget to give us a like and share the episode with your family and friends. See you soon.